Welcome, dear viewers. Today, we have an exciting and informative video for you on how to use technical analysis for cryptocurrency trading. As the world of cryptocurrencies continues to grow, it's essential for traders to understand the various tools and techniques available to make informed decisions in this fast-paced market. So, buckle up and get ready to learn the ins and outs of technical analysis for cryptocurrency trading. But before we dive into the specifics, please remember that I am not a financial advisor. These videos are for educational purposes only. Investing of any kind involves risk. While it is possible to minimize risk, your investments are solely your responsibility. It is imperative that you conduct your own research. I am merely sharing my opinion with no guarantee of gains or losses on investments. Now, let's dive into the key points we'll be discussing in this video. 1. Understanding technical analysis basics. 2. Chart types and time frames. 3. Support and resistance levels. 4. Trend lines and moving averages. 5. Technical indicators and oscillators. 6. Chart patterns and formations. 7. Developing a trading strategy. We'll go through each of these points in detail, ensuring that you, as a beginner, can grasp the concepts easily and put them into practice. So, stick around and don't miss out on any crucial information that could give you an edge in the world of cryptocurrency trading. Let's get started. All right, let's dive into the first topic, understanding technical analysis basics. Technical analysis is a method used by traders to evaluate and predict the future price movements of assets like cryptocurrencies, stocks, and other financial instruments. It's based on the idea that historical price data and patterns can provide valuable insights into how the market might behave in the future. Now, you might be wondering, how does technical analysis work? Well, it relies on analyzing price charts and various other tools to identify trends, support and resistance levels, and potential reversal points. This information can help traders make informed decisions on when to enter or exit a trade, maximizing their potential profits and minimizing losses. One key concept to grasp is that technical analysis is not about making exact predictions, but rather about identifying probability. This means that while we can never be 100% certain about what will happen in the market, we can use technical analysis to increase our chances of success by identifying patterns that have a higher likelihood of playing out. A crucial aspect of technical analysis is that it's a self-fulfilling prophecy. As more traders use these methods, their collective actions can reinforce the patterns and trends they're observing, making them even more likely to occur. So, as a beginner, it's essential to familiarize yourself with the basic concepts and tools of technical analysis. This will enable you to better understand and interpret price charts and make more informed decisions when trading cryptocurrencies. Remember, practice makes perfect, so keep learning and applying these concepts to build your skills and confidence in the world of crypto trading. Now let's move on to our second topic, chart types and time frames. When it comes to technical analysis, selecting the right chart type and time frame is crucial for understanding market trends and making informed trading decisions. There are three main types of charts that traders commonly use: line charts, bar charts, and candlestick charts. Line charts are the simplest, showing only the closing prices of an asset over time. Bar charts provide more information, including the open, high, low, and close prices. Candlestick charts are the most popular among crypto traders, as they give a visual representation of price movements and patterns in a highly intuitive way. As for time frames, traders can analyze charts on various scales, from intraday, e.g., 1 minute, 5-minute, 5-minute, or hourly charts, to longer term time frames, e.g., daily, weekly, or monthly charts. Each time frame offers a unique perspective on the market, and the choice depends on your trading style and goals. Short-term traders might focus on smaller time frames, while longer-term investors may rely on daily or weekly charts to identify trends. Understanding the different chart types and time frames is essential for developing a solid trading strategy that suits your preferences and risk tolerance. So, be sure to experiment with various chart types and time frames to find the right combination for your trading style. And remember, if you find our content helpful and informative, please don't forget to like this video and subscribe to our channel for more valuable insights and tips on cryptocurrency trading. Moving on to support and resistance levels, these are crucial concepts to grasp for anyone looking to trade cryptocurrencies using technical analysis. Support and resistance levels are price points at which an asset's price struggles to move beyond due to market forces. A support level is a price point where buying pressure is strong enough to prevent the price from falling further. Think of it as a floor that the price bounces off. Conversely, a resistance level is a price point where selling pressure is strong enough to prevent the price from rising further, acting as a ceiling that the price struggles to break through. Identifying support and resistance levels can help you make better, informed decisions when entering or exiting a trade. Traders often look for buying opportunities near support levels and selling opportunities near resistance levels. Keep in mind, though, that these levels can be broken, leading to new support and resistance levels being formed. By understanding and identifying support and resistance levels, you'll have an additional tool at your disposal to make more informed trading decisions and potentially increase your chances of success in the cryptocurrency market. Let's now explore trend lines and moving averages, two essential tools for cryptocurrency traders. Trend lines help you identify the direction of a trend, while moving averages smooth out price data to reveal underlying trends more clearly. Trend lines are straight lines drawn on a price chart, connecting multiple price points to illustrate the general direction of the market. An upward trend line connects the lows, while a downward trend line connects the highs. When the price consistently respects a trend line, it becomes more significant, and traders pay closer attention to it. Moving averages, on the other hand, calculate the average price of an asset over a specified period. There are various types, such as simple moving averages, SMO, and exponential moving averages, EMO. Moving averages can act as dynamic support and resistance levels, and when a short-term moving average crosses a long-term one, it often signals a potential trend change. By incorporating trend line and moving averages into your trading strategy, you'll be better equipped to recognize market trends and make informed decisions based on price action. Now, let's dive into the exciting world of technical indicators and oscillators. These tools provide valuable insights into market conditions, helping you make informed trading decisions. Technical indicators are mathematical calculations based on price and volume data. They help traders identify trends, momentum, volatility, and other market characteristics. Some popular indicators include the Relative Strength Index, ERC, Moving Average Convergence Divergence, MACD, and Bollinger Bands. Each has a unique purpose and can be combined with other indicators to create a comprehensive trading strategy. Oscillators, on the other hand, are a subset of technical indicators that fluctuate within a specific range, usually between 0 and 100. They help traders identify overbought or oversold conditions, which can signal potential trend reversals. Examples of oscillators include the stochastic oscillator and the commodity channel index, XE. When using these tools, remember that no indicator or oscillator is perfect. Use them in conjunction with other analysis methods and always consider the broader market context before making any trading decisions. Let's explore the fascinating world of chart patterns and formations, which can offer powerful insights into future price movements. Recognizing and understanding these patterns can make a significant difference in your trading success. Chart patterns are formations that appear on price charts and can signal potential trend reversals or continuations. They are based on the psychological factors that drive market participants' decisions, such as fear and greed. Some common chart patterns include head and shoulders, double tops and bottoms, triangles, and flags. When analyzing chart patterns, it's crucial to pay attention to the volume, as it can provide additional confirmation of the pattern's validity. For example, a breakout accompanied by a surge in volume is typically seen as a stronger signal than a breakout with low volume. Keep in mind that chart patterns are not foolproof, and it's essential to combine them with other technical analysis tools to increase their reliability. Always consider the broader market context and be prepared for the unexpected. Developing a solid trading strategy is vital for success in cryptocurrency trading. It helps you make informed decisions and manage risks effectively. Let's dive into the steps you need to follow for creating your own trading strategy. First, define your trading goals and determine your risk tolerance. This will help you understand what you want to achieve and how much risk you're willing to take on. Make sure to set realistic expectations and avoid impulsive decisions. Next, choose the right technical analysis tools and indicators that align with your trading style. Whether you're a short-term trader or a long-term investor, it's essential to pick the tools that suit your needs and preferences. Third, develop a set of rules for entering and exiting trades. Establish clear criteria for when to buy or sell and stick to them. This helps eliminate emotional decision-making and improves consistency. Finally, test your strategy using historical data or paper trading before applying it to real-world trading. This will allow you to refine your approach and gain confidence in your plan. In summary, technical analysis can greatly enhance your cryptocurrency trading experience. By understanding the basics, exploring chart types, and mastering various tools and techniques, you'll be better equipped to make informed decisions. Always remember to keep learning and evolve in your strategy, as the cryptocurrency market is constantly changing. Thank you for joining us in this journey through technical analysis for cryptocurrency trading. Don't forget to subscribe to our channel and like this video for more educational content. Stay safe and happy trading.